Welcome to the Daily Brief, where I'll go over the highlights for the action in the market for Thursday, December 1st, and then we'll see how things are looking for Friday, December 2nd. And not necessarily surprising, we did have a little bit of a down day. After the big move up in Wednesday's session, we overdid it. And at least on a one-day basis, going from Tuesday to Wednesday, we were showing some extreme readings as far as the rate of change one day and the advanced decline line one day. Well, those got worked off in Thursday's session. Now, in this video, I'm going to go through a bit more charts than what I've been doing lately. I'm going to go through the positive setups and the sector rotation just because it's been a while since I updated that. So I wanted to give you an idea of what's happening in those areas. They're still holding up. The sector rotation is not doing as good as we hoped, but our other setups are still looking much better for the time being. Can we hang on to that? That's the thing. We've seen these setups a lot in 2022 looking like, okay, here we go. We're going to launch and go higher from here, only to have it fizzle out and have things come into the market that stall this real attempt at going higher. But for right now, things are showing some improvement. All right, let's go back and talk about what happened. At the open, we did have a higher open, and a lot of that was probably carryover from Wednesday because you have people that came home on Wednesday and went, oh my gosh, the market was up over 3%. I got to get into my account and buy some stocks or get into some index funds or do something. And so they pumped prices a little bit up at the open, which is fairly common what they do there. And then there was a bit of gyration where we then fell back after the open, but then we just chopped sideways for most of the session. So we did hit resistance right after the open at 4,100. We're not quite there yet to, at least in Thursday's session, to deal with that. Now, Friday, we're getting the employment situation report coming out. That's the main report, not only for the day, but for the month. And this is what the Fed is really starting to key in on is the employment. What's going on? What's the unemployment rate? What's happening with the employment situation? That's what they're really keying on to justify the rate increases, even though we're seeing in a lot of the rest of the economy, things really slowing down and actually showing some weakness. Anyway, that may get dealt with in Friday's session. So we hit that 4,100 level, then we reversed and we actually went down and went negative. We spent the rest of the day moving sideways and being slightly negative. We were just down 0.09%. And then volume slipped back down to below average. Again, not necessarily a surprise. We had the big reaction day on Wednesday. Things were pretty calm on Thursday, so volume really decreased. The technicals are still holding up overall. We're still looking positive. We're still hanging in there. Can we hold on to this? And then can we build from that? And inflation and interest rates, that seems to be, that's the fixation, but it seems to be a little bit more favorable now because a lot of market participants feel like they understand better that the Fed is actually pivoted. Instead of building this fairy tale scenario and then hoping the Fed will do this, now we actually have something to back that up. We'll have to see. Is this going to carry over into an even weaker economy as we head into 2023? And of course, any of the Fed speak that may come out. We didn't get any additional Fed speak on Thursday, at least that I found, but that could always change. Here's the intraday chart where we had a gap higher open, a little bit higher, not really a gap. We came up to 4,100. We fell back down. We never hit a support or resistance level or a pivot level. We came back up to the unchanged level, which acted as resistance in and of itself. That's kind of a built-in support or resistance level that we have every day. We went a little bit positive near the close, but then dropped below and just pretty uneventful on below average volume. So what are some comments that we can make? The S&P did successfully test the 200-day simple moving average. That is positive for right now. Can we hang on to that in Friday's session if we end up going back down to that level? And I have a chart to show you. The dollar's been getting really hit hard. And as I've been saying in the videos, if we see some kind of recovery in stocks, it's probably going to be at the expense of this strength that we've been seeing in the dollar. So I'll show you a chart, and then interest rates. I'll also have a chart to show you that, because interest rates have been coming down. The VIX is extreme negative again. We've actually dropped below 20. That's the static value that we use. That's kind of more the textbook use of the VIX, using that static 20 level, but we need to be more fluid than that. We have to adjust it on a relative basis, but I'll show you that chart. And then on the short-term basis, we have the Stochc RSI, the Williams percent, our moving average studies, and our different stochastic studies. Those are the short-term indicators that are still extreme positive. We haven't worked those off. We did from Tuesday to Wednesday, that extreme movement, that got worked off, but these are a little bit longer that we use for our short-term indications of what's happening. They're still extreme positive. In the intermediate term, we have a couple more additions to the list. The rate of change going back 20 periods, the CCI 14 and 20, those are both extreme positive, and then the BPI. And I do have a BPI chart to show you. We still have all the yield curves that I follow are inverted. Sentiment is still positive. We haven't drifted over into the extreme positive area, at least yet, so we can kind of go with sentiment. That's on the chart that we use. Now, yesterday I showed the investors' intelligence, where they had been extreme pessimistic, and we're coming up out of that now. That could also give some support to stocks. The economic reports that came out, we had personal income. It was up 0.7% on a month-over-month basis. That was more than the 0.4% that they expected. And personal spending it came in line at being up 0.8%. The PCE price index, this is kind of a biggie, came in a little bit weaker than expected at 0.3%, where they expected it to come in at 0.4%. And then when you take out food and energy, it came in as expected, up 0.2%. Jobless claims were a little bit less than what was expected, and this is what the Fed is starting to watch. Not only the reports that we're getting all week, but in the employment situation report that will come out on Friday. And then we had the final IHS market manufacturing. It came in at 47.7, where last time it was at 47.6. Not a lot of change there, but it's still below 50. And the ISM manufacturing, it came in at 49%. They expected it to be at 49.8%. That was weaker than expected. And this is a little bit more important. This is actually quite an important economic report. The last time we got this, we were at 50.2. Now we're at 49, so anything below 50 does show contraction. Construction spending was down 3% on a month-over-month basis, a little bit more than the minus 0.2% that they had expected. The last time we got this, it was up 0.1%, and on a year-over-year basis, it's up 9.2%. Our trend is still positive and getting stronger. With the solid update on Wednesday, the ADX is still continuing to go above that 20 level even more. Even though we had a slightly down day in Thursday's session, I'm keeping the bias as positive because it was so choppy. It was just kind of an exhaustion day after the big run-up, and I'm keeping our momentum at positive currently. Here's the chart that I've been showing in all the videos, how we've been kind of following along with what's been happening between 2006 and 2008. That's the green line, and that would suggest that we might see some weakness ahead if we continue to follow the same basic path that we did back in 2006 to 2008. Here's the VIX chart also showing that we're getting, and you'll see it later with the updated charts that I have, we're getting pretty low with the VIX. That means that things are getting complacent right now. Well, when this really starts to go up, that tends to happen when we're falling. We're not really seeing that yet, but if we follow the same basic pattern that this seems to be kind of matched to, then we might see some declines based on that. So this chart here and this chart here, these are warning signs. These are, I'm not necessarily saying this is what's going to happen. These are just things to be aware of if we continue to follow the same patterns that has happened in the past. All right, then here's our rate of change going back 20 periods. showing that we're getting a little extreme positive. Here's the BPI. This really held up even during the holiday week last week and earlier this week. This didn't really drop with a lot of our other indicators. So I'm taking that as a positive divergence, but we're starting to get pretty extreme here. So that is a bit concerning, but it is showing good solid momentum. Here's the VIX, how we drop down on a closing basis below 20. This is the line chart. We're on the bar chart, and we close kind of near the bottom of the bar for today's session. Here's the VIX, where as it's been going down, as stocks have been going up, we're starting to get ever so slightly into the RSI 9-period extreme negative. So that's opposite to what stocks are doing, because the VIX goes down when stocks go up. So we've been down in this area recently, but it hasn't produced a real big movement, at least yet, in the VIX. Here's our trend where we're coming a little bit more up above 20. So we're in a trending environment. The green line's on top, so that's positive. And we're above the moving average. Then here's our equity put call ratio, which is still really high, but it has been just really spiking lately. You had a lot of fear in the market, and people that use puts to hedge their investments, they were buying a lot of puts. And then folks that were sure we're just going down, so they're just getting puts as a more directional play. It's coming down from these readings, but like I just said, they're still pretty high. But then with our 5-period moving average, again, still quite high, but we're starting to see, can we work off of this spike? Because this oftentimes is one of our positive setups. I'm letting this develop a little bit first, but a lot of times when we have a real spike and then we start to come back down, that does give support to the S&P to go higher. Here's the daily chart showing we really dropped off with volume. We came right up to this trend line. So that is acting as overhead resistance, and that's at about 4,100 currently. But we've been able to stay above this other support level. This had acted as resistance, but it's now acting as support, and we're still above the 200-day moving average. So all of this is positive right now. We have to say, okay, where do we go from here? Are we going to break above 4,100? That would be quite positive, especially if we close there. As we get later in the day on Friday, if things are positive, we're going to be seeing if we're at 4,100 or above. If things are negative, we're going to be watching this level, which is at about 40.75-ish or so. And if we drop down below that, and then that's also where the moving average is, and we come down and actually look to close below that, that would be a bit more negative currently. All right, here's our moving average tree showing how we came down to the 200-day simple moving average, and then we're able to bounce up off of that. Right now, that is quite positive. Here's the highs and lows where I brought this up in yesterday's video because it was a little bit concerning. Well, with the upward movement at the earlier part of the day, we saw a breakout in new highs, and that has turned our 5-period back up, and we're going up slightly with our 10-day. So this is looking better right now. Fibonacci levels, we're still kind of in no man's land between this full retracement going back to the September high and this other level, which is going back to the August high. We're not really dealing with either one of these levels at this time, but that could quickly change. If we do end up going higher, we're looking at the 41.28 level, and that might act as overhead resistance. And if somehow the market could get some real strength behind it and close above that, that would be quite positive. As long as we stay below this, this still could act as overhead resistance. If we're more negative and we start to go down, we're looking at about the 40.08 level or 40.10 or so as a support level. Here's longer term, where we did break above this 50% retracement level, and we're still above that right now. If we start to fall, this is that 40.20 area. If we come down, we want to see, is the market going to hold 40.20? If we continue to go up, we're looking, well, it's quite far away from right now, but the next retracement level that we have here is at about 42.13. Here's the dollar, where we've just been in a really solid uptrend for most of 2022. And then we've been starting to come down. Now we're still in an uptrend because this shorter term moving average is still on top, but we're seeing some real weakness, and we actually closed down below the 200-day moving average. Here's treasury yields, just to give you an eye what these are looking like, how they have been falling for the most part recently. So you have the dollar declining and interest rates going down. That's giving support to stocks. Can that continue? Here's our sector rotation and setups. This is a 19-day exponential moving average of the advanced decline ratio based on price and volume. We had an extreme negative reading, both with price and volume. And now, as the S&P has been going up, this has been going up as well. We're starting to get a little up here as far as price. We still have a little more ways to go based on volume, but this could be a positive setup that we're seeing as the S&P tries to go higher. Here's a look at just the S&P 500 stocks that are above their 200-day moving average. We had a double bottom here with an extreme negative reading. We didn't quite get down to a complete washout reading like we've had before, but we bounced up off of this, and this is showing some improvement. And the encouraging thing here is this was holding up better. Even when we were going down earlier in the week, we were still seeing this just continue to advance. And if you think about it, well, these are 200-day moving averages, so they're not as susceptible to the daily movements. Then another shorter term measure that we look at is we look at the S&P, the mid caps, and the small caps, and their relation of the 50-period moving average, where we had an extreme negative reading, and now we've been coming up out of that. Not quite extreme positive yet, but we're showing some strength there. That's for the S&P. Here's the mid caps, where the same thing. We had an extreme negative reading, and we've been showing some improvement here. And then the small cap, extreme negative reading and showing some improvement. But you notice how the small caps have been lagging a little bit. The mid caps have been doing better, and the S&P's been doing better. So this is a little bit of a warning sign. We'd like to see the small caps outperform because these are considered riskier stocks. If hedge funds or investors get into those, it means they're willing to take on a little bit more risk to possibly get more of a reward. And if they're not doing that, then what are they going to be doing with the blue chip stocks? It just shows that they're a little bit more apprehensive. All right. Another thing that we look at is the 10-day average of the highs and lows. This also held up pretty well, even when we were declining last week and earlier this week, where we had an extreme negative reading, and we've been coming up since then. And this is also a longer term measure. And again, if you look back on all of these setups that I'm showing you here, if you look back, when we hit a bottom, that often marked a bottom in the S&P. And then as this was going up, the S&P would go up as well. We've seen that a lot in 2022, but we see them fizzle out. And so we have to be vigilant about watching these things or being too confident in this. Another thing, the S&P to the utilities ratio, after coming down and hitting a low and bouncing back up, it hasn't really been doing all that well. So this is a bit of a warning sign. A lot of times when the utilities come down and hit a bottom and then start to go back up, that gives support to the S&P. When we hit a top and then start to come down, a lot of times that will be a top in the S&P. Well, we're seeing this coming down a little bit. So the utilities are really underperforming the rest of the S&P currently. So again, just a warning sign for right now. Another thing that we look at is the 2-year yield. A lot of times when the 2-year yield comes up and spikes and then goes back down, that will give at least some short to intermediate term support to the S&P. And we've just been going, we looked at this spike right here where my cursor's at for a long time. Well, as interest rates really started to go up, we took out that spike, we set another spike, and we're coming back down. The problem with this is we don't really know if this is a true spike or not. We will only know this in hindsight. We just kind of have to look at this, be aware of this, and then say, okay, we may have spiked right now. And if it continues to go down, that means interest rates are going down on the short-term basis, and that could also give support to the S&P. Then another thing is the staples. These are the things that you have to have no matter what is happening in the economy. when we spike up with this on a ratio with the staples to the S&P 500 and then come down, that often marks some kind of a bottom in the S&P. Well, we've been just spiking all over the place, coming back down, hitting another spike, coming back down. So this is looking better, but this is part of what has fooled us in 2022 because it's not as clean as some of these other spikes that you see. We've been going up, coming down, going up, coming down, hitting a new spike, and then coming back, not hitting a new high and coming back down. But this is showing some improvement as of right now. Okay, and then I don't know, oops, I hit the wrong button. Okay, here's our sector rotation, where what we were seeing at the end of 2021 was a negative divergence, where we were making, actually, this goes into 2022. Enough time has passed. I don't have 2021 on here right now, but we were making a lower low with the S&P, but we were making a higher low when you compare the Qs to the S&P. And that was looking pretty good here for a while. And then it started to show some weakness. It's coming back a little bit, but it still needs to show some more improvement. Same thing with discretionary, where there was a positive divergence back in June, from May into June. And this was looking pretty good for a while, but then over the summer and into the fall has been showing some weakness, but lately we're seeing some improvement. And the same thing is true when we compare the growth, large cap growth stocks with the large cap value. Also a positive divergence, was looking better, but then started to break down here. It shows some improvement currently. And then another chart where we look at the growth to value ratio with the large, mid cap, and small caps. Again, we broke down below this low, but we are showing some improvement. The mid caps are showing a little bit more of improvement, and the small caps are showing some improvement as well. So this is what we were using to justify that instead of being in the more defensive value stocks, which most of the smart money has been in for 2022, they're getting out of that and starting to go back into growth stocks. And that's when you see the real upward movement in the indexes and in a lot of the growth-oriented stocks. All right, so what's our outlook for Friday? The technicals are still positive and strengthening. We're short-term overbought, and we're a little bit overbought in the intermediate term. And we're still asking this question: has the pivot that we've been waiting for from the Fed, has that happened finally? We have the employment situation report coming out, and that's a big one. And that's really the only report I could find. We've got the whole list of geopolitical events, the lockdowns in China and the different protests that are going on. But the market is still really fixated on this inflation and interest rate issue, which seems to be turning a little bit more stock market friendly for right now. And then down here in blue, the looming railroad strike. Yesterday, I talked about how the House had passed some kind of a measure to try to avert that strike. Apparently it was passed in the Senate, so let's hope that will do the right things to avert that strike, because that could have a real impact on the U.S. economy. So our scenarios, not going with the down scenarios other than the fact that we are short-term overbought, and we kind of chopped sideways in Thursday's session. Now, if the employment situation report comes out hot, then we might really see some weakness in the market. If it comes in where it's as expected or even weaker than expected, the market, well, we'll have to see, because we're in that kind of in between now where is good news or is good news bad news, and vice versa. So we're waiting to see how the market is going to treat this report. We're going with the up scenario now because all of our charts, the oscillators, were above some key moving averages. Our indicators are still positive for the most part, but in the short term, we're overbought. I showed you the scenarios, rotation, and setups that we have going on right now, just to update those. Our technicals are still looking okay. We're still above moving averages, pivot levels, and fib retracements. We still have overhead resistance. If we continue to go up, we still have some support levels that I tried to mention here. If we start to go down with any conviction, not going with the sideways trend currently because the ADX is above 20 and it is positive. So our conclusion, the S&P is positive and getting stronger. Thursday's a little bit of a down day. Really, it did more help that I can see. Yeah, it had a few more of our indicators switch over to extreme positive, especially in the intermediate term, but it's trying to work off this overbought condition. In the short term, we're still overbought. Intermediate term, we're slightly overbought. So we might need some more than just Thursday's action to take care of that. Long term, we're above the 200-day moving average, but until that 50-period moving average crosses above the 200, we're still negative overall, but it is showing improvement. So thank you. Have a wonderful Friday. I'll prepare what I am able to prepare over the weekend. And as far as the weekly video and intermarket analysis video, I'm still at the point where it's hard for me to look at the screen for long periods of time. And so I don't want to take too big of a chance in doing that. So have a great day, and I will talk to you in the next video.